Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Cut to the Chase. Now today I wanted to talk about gold. As I know only too well, most families have at least one member who extols the virtues of owning gold and urges the family to buy more. Now personally, while I usually prefer to separate investment and jewelry needs, its appeal as an investment has remained undiminished through time. Now more recently, gold has been under some pressure after outperforming spectacularly in the early part of 2022 when most other major asset class prices fell. The price of the precious metal has fallen and is now lower than where it was at the start of the year. Now we'd start with a little bit of fundamental context. Gold is a rare asset class that does not offer a yield and is usually priced in US dollars. So in terms of macro drivers, these are the two we usually focus on. So in other words, real or net of inflation bond yields and the US dollar. Now all things considered, lower bond yields usually are supportive for gold because they reduce the opportunity cost of owning the non-yielding asset and vice versa. Similarly, a weaker US dollar is positive for gold and many commodity prices, and the opposite of course holds true for a stronger dollar. Now while these are the main drivers, we'd argue gold has actually held up relatively well this year despite both of these fundamental drivers moving strongly against the metal. Bond yields and expectations of interest rates in the future have risen sharply in recent months as Fed messaging caught up to the high inflation numbers. The US dollar has also been very strong as the Fed's efforts to push rate expectations higher supported the currency in relative terms. Now, a third driver, if we can call it that, has undoubtedly helped with this resilience. Gold is often viewed as a safe haven that can provide a useful offset during the early stages of a risk asset sell-off or during periods of unusual uncertainty, such as rising geopolitical risk, as exemplified by the start of the Ukraine conflict earlier this year. More recently, though, this source of support has also waned as the risk asset sell-off stabilized and the unusual inverse correlation between equity and bond prices started to return. Now, this recent weakness notwithstanding, we do see both a short and long-term opportunity in gold. In the short term, this is largely a technical one. The fall in prices over the past month has meant gold positioning has lightened up significantly, and many technical indicators are at oversold levels. Now, these have occurred as gold prices have approached the key $1,675 to $1,700 support area marked by the early 2021 lows. Now, regular readers of our daily FX Navigator will know that we have recently initiated a new bullish gold idea around these support levels. The idea targets a rebound in gold prices all the way up to $1,825 while setting a stop loss just below the $1,675 support. Now, while technicals might be a key factor behind the short-term rebound expectation, fundamentals are increasingly supportive of this as well. A relatively aggressive Fed rate hike cycle is arguably well in the price now, and long maturity bond yields interestingly did not move higher despite the recent US inflation print. This could also signal the US dollar is taking a pause. Together, this means both key drivers could be turning a little more supportive of the precious metal. Now, that's the short-term view, of course, but longer term, we do continue to see gold as a preferred asset class. The changes in drivers we discussed is one factor behind this view, but we also see gold as a useful portfolio diversifier in a market where inflation worries are unlikely to completely go away, at least for the rest of this year. So there's an idea to think of both in the short and long term, but we'll take a pause here. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening and wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.